We have some mixed performances right across the S&P just over the last week, and today we have data that the inflation rate has come in at 2.4%, which is marginally higher than what the market was estimating. Now today we're drawing your attention to Alibaba, which has been on a very strong run just over the more recent quarter. It is up around 27%. We do also note a strong buy rating from Wall Street, and in fact when we look at the performance over the last 10 years, whilst it has been very poor, up only 21%, we can see all-time highs well over $300, although we are talking about 4 years ago. So let's find out whether or not we believe this is a great opportunity to buy this company, and if we can see it increase more than 3 times over the next few years. What's interesting to note is that a lot of Chinese stocks did rally quite significantly, and this was due to the fact that Beijing had some stimulus plans, and the market overall did like this, as we can see Alibaba then closing over $100 per share, and this was quite a feat as we hadn't seen this in quite some time for this company. What this has ultimately meant is that a lot of investors in China see this as a great opportunity to start investing into their stock market and hopefully see some nice gains, create that money, as currently we can note the Chinese economy itself is a little bit sluggish. Now off the back of that, we did actually get some news that wasn't what we wanted to hear, or in fact what the Chinese investors or those who have shares in these companies wanted to hear, where in fact earlier this week we were expecting a bit more information on this stimulus. We didn't get that, so the market has ultimately taken a little bit of a step back, and as we will come to show you, it is down around 5%. So let's have a very quick look at the performance of this company. As we said, not great over the last 10 years. Over the last year, and in fact year to date, a very strong rally as we heard from that information of the stimulus being prepared, up 41%. Over the last week though, as we haven't got more information, it is down around 6%. Nonetheless, this company is trading at the upper end of the 52-week range. It also does offer a yield of 1.85%, something that is fairly new, although we did get a recent 5% dividend increase, and we can see the forward PE is trading at 12.26, which does look very cheap when we do look at the metrics today. In terms of their expectations for the earnings moving forwards, we do note out of the next 4 quarters, they are expecting 3 of them to be growth. However, quarter 2 2025, they are anticipating a drop of 4% year on year to the EPS. And when we do look back over the last 4 quarters, they have a 50% track record, 2 beats, 2 miss. Nice to report the last quarter was a nice beat of around 20 cents. And with the growth anticipating over the next few years, March 2026, that forward PE for Alibaba is estimated to come down to around 11.03. Now, we've seen investors put a lot of money into this market, and none other than Michael Burry, who does in fact hold around 21% of his portfolio in Alibaba, and we also note he added around 24% more just in the latest quarter. Now, this isn't the only company in the Chinese market. We can also see Baidu, which he did add around 88%. That's around a 12% position. Likewise, JD.com, which did suffer a little bit, is around 12% of his position. He did reduce that, however, around 31% in the latest quarter. Now, this is just something interesting to bring to your attention. Ultimately, we shouldn't consider this a signal to buy, but as always, we do like to incorporate some external analysis within our reviews. Now, in terms of the actual underlying metrics of the company, free cash flow payout does look very strong, 11%, 12% over the last few years, expected around 11% over the next 12 months. And while we were a bit disappointed about that 5% dividend increase, we do expect with the very low payout, they can, if they want to, increase it at a much larger rate. Free cash flow per share, ultimately we want to see increases over the longer term, which is something we do get from this company, pretty much quadrupled from 2015 to 2024, a little bit of inconsistency on a year-on-year basis. Nonetheless, over the next 12 months, they are anticipating this to increase, which is ultimately what we do want to see on this channel. One question mark though we do have around this company is the decreasing nature in their sales growth. Whilst we do get double digit nearly every single year, 2% in 2023 is pretty poor, and 8% on 2024, whilst it is nice to see, as we want ideally 3 to 7%, it is a little bit disappointing given the previous nature of their growth, something just to consider and something we will ultimately factor in to our margin of safety today. Now, from a numerical standpoint, we can see the tremendous growth, more than 10 times from 2015 to 2024. And the shares outstanding, we do have to note, whilst the position or net position from 2015 to the latest quarter is pretty much minimal, they've done both share issuances as well as share buybacks. Nice to report though, from 2021 over the last 3 to 4 years, they have started to do share buybacks, something we do believe they will continue to do. Given the last time we did look at this company, they did report this is part of their program. They do in fact have authorization for share buybacks over the next few quarters. Now, ROIC, 10% or more, give us that faith. Management are able to effectively allocate their capital. We can see pretty much there or thereabouts on a year-on-year basis. Nice to report 10% in 24, 10% on a trailing 12-month basis. And something we really don't want to see on this channel is operating margin decreasing, so that inefficiency as opposed to efficiency. We want to see margins increasing on a year-on-year basis. This ultimately has come down to around 15% in 2024. And whilst we ideally want to see a minimum 16%, again, we are noting their top line revenue has been decreasing as well as their margin. Typically on this channel, we call high quality companies when we see increasing revenue and increasing margins. Just want to flag for Alibaba, we see the opposite on both sides. Free cash flow margin, we also see it decreasing, although minimum 5% is achieved every single year and 16% in 2024 is still respectable. Again, just things that we are flagging. The final part of this metric, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, shows us the number of years it would take this company to pay off all of their debt net of cash on hand. 0 right across the board, 0 over the next 12 months, so it wouldn't even take them one day, emphasizing how strong of a balance sheet this company does have, and something that we will show you shortly as well in terms of the actual numbers. We also want to let you know that we release a weekly free article every single Monday morning that comes directly to your inbox. We talk about what's happened in the market over the last few days, as well as undervalued dividend stocks that we do believe deserve your attention. So you can click on the pinned comment below, sign up and read these straight away. On top of that, you will gain access to 36 undervalued dividend stocks for the month of October, where we also look at those that sit within our portfolio and give some information that we do believe is useful. You can also now grab a copy of this 22 dividend stocks that Wall Street themselves believe have the most upside in the market, with their forecast going over the next year. So again, click below, sign up, and you can read straight away. We also like to look at what the institutions themselves are doing. Around 13.5% ownership, 2.8 billion worth of sales over the last year. We see double the amount of buyers in the same time period, so clearly they do like this company. And in fact, when we do look at quarter 3, we do note they have been buying more in the short term as well. So overall, institutions do like Alibaba. They've been buying more over the 12 months, as well as buying more just over the last quarter. But again, do your own due diligence. Never copy what these institutions or even super investors do. Now, in terms of the actual numbers of this company, so we'll start off with the income statement. Now, we've already touched upon their revenue. It has been growing at a very rapid rate, although we do note this has started to slow down in the more recent years. As we can see though, astronomical growth, 12 billion to 130 in March 2024. However, this part of the analysis, the highlight is the bottom line, what is going on with that. And we actually get a lot of inconsistency on a year-on-year basis, which is never good to see. Whilst revenue has been increasing significantly, their bottom line, 3.9 billion, has increased to 11 billion. But we can see just from a numerical performance that it is very, very inconsistent. And as always, you do expect companies with their revenues to increase at a very rapid rate, their bottom line net income to follow suit as well. In terms of the balance sheet then, total cash versus total debt, we just want to highlight how strong it is. 20 billion of cash in 2015. I mean, from a graphical perspective, we can see very nice. Similar to revenue growth, their cash has also been growing. Now pretty much tripled to 62 billion in the latest quarterly report. And when we do highlight their total debt, both numerically and directionally, we can in fact see that it has gone from around 8.5 billion in 2015 to 33 billion in their latest report. This does highlight though their cash is far superior, nearly double, and as we already said, if they wanted to, they could pay this off all in one day. But we do also note, similar to other metrics like cash, total debt has been increasing. So again, something to flag, something to consider. Now, in terms of some of their gradings, we'll start off with the valuation where they do get a D. Their forward P on a non-GAAP basis of 12.2 is below the sector median of 17, so it is a B plus rating, pretty much giving you a 28% discount right now. Whether or not you believe that is enough of a discount to invest in this company or in this market, that is something to consider, but we do know, depending on what metric of valuation you use, some metrics do show a nice discount, other metrics though do show in fact paying a premium. We will cover however the actual valuations shortly as well. In terms of the growth grade, well, they get an F. In reality, their revenue year on year at 6% is better than the sector median of 2%. Forward looking as well, better at 7.6 versus the sector median of 3.5. However, one thing that does come under, which does reduce that rating, their earnings per share is only anticipated to grow at 4.7%, where the sector right now at 10.62 does look a lot better. So something to consider, their growth doesn't look that great, but the one thing that we really do like about this company, as we can see here, their profitability does look very good. They get that A+. Now their margins pretty much is in line from a gross margin perspective, 37 versus 37. Their bottom line is a little bit better, 7.4% versus 4.55, but the one thing that really stands out here is that cash from operations, 23.5 billion over the last 12 months, the sector as a whole 287 million. Now quick recap, we have a buy rating from Seeking Alpha, a strong buy from Wall Street, a hold from Quant, D on valuation, F on growth with an A+ on profitability. Now before we do jump into the valuation, we can have a quick comparison against others in the industry. We have the broadline retail market, PDD Holdings, Process NV, Mercado Libre, a very strong company, JD.com as well as Coupang. Now in terms of over the last 12 months total return, Alibaba is up around 32%, pretty much towards the bottom, but we do note the whole market as a whole has performed fairly respectable over the last 12 months. When we look over the last 5 years, we do in fact note it is down around 33%. Remember, it did have all-time highs of over $300, and over the last 10 years, we can see very marginal growth, in fact, one of the worst performing. Now, this is all just informative, as ultimately the past performance doesn't give us any indication of the future. Now let's jump into the valuation. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now $117 intrinsic value, we have got this from our 3 models today. Graham's valuation, we have the stock ticker symbol, EPS, long-term growth rate, AAA corporate bond yield to give a marginal overvaluation signal, $104 versus the market price of around $109. Remember though, we don't look at any of these models in isolation. We then have the multiples valuation. We've gone from a couple of companies, similar sector and size, their average P multiplied by the EPS of Alibaba. Again, we do have another marginal overvaluation. We then move on to the dividend discount, which would typically be a model we use. However, given the fact that they have just started to pay a dividend, we don't believe for now this is relevant. So we go straight onto the final DCF model, where we have the free cash flow year on year. Now the average growth rate just under 20%. We want to be very conservative and say, look, with no growth rate, this is what the intrinsic value would be. So with the discount rate, we get the present value of future free cash flows terminal value, add together with the cash, subtract total debt, get to equity value, and get to that intrinsic value of $148. Now, as we can see, the intrinsic value today, 117, is the average of these 3 models and is pretty much not too dissimilar from Wall Street, their target of $118, where they see upside of 8% over the next 12 months. Now, what we typically do on this channel is we start off with a 10% MOS, and remember, we execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now, as we can see in today's episode, it doesn't quite hit that just yet, not too far off it, so you could say Alibaba has a near 10% MOS with around 8% upside from Wall Street. Now, what I would say is, for me personally, this isn't a large enough MOS, but when we did previously review this company, it was trading around $70, where it did look a lot more attractive. Now, for those that just want to know, at a 15% MOS, there would be a buy at around $100, at 20% around $94, at the 25% mark around $88, and at 30% MOS $82. However though, in today's episode, we are just seeing a 10% margin of safety. Now, one thing that you can also consider is investing in an ETF which does cover China, just to get that exposure to Alibaba, but maybe also the security. So we can take a look at iShares MSCI China ETF. Now, the expense ratio is a little bit higher than maybe what we would like to see at 0.59%, but we do note year to date is up around 30%, but majority of that is just in the more recent period where we did see that talk of a stimulus to the economy. In terms of the total return over the last 3 years, negative 7%. In terms of over the last 5 years, pretty much flat. And over the last 10 years, 2.59. But again, this is just something to consider for those that do want some exposure moving forwards to the Chinese market. And in terms of the holdings, well, we can in fact see Alibaba is the second with around 9%. Their number one is Tencent holding around 16.25. As always though, do give us your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button. Also, don't forget to sign up to the free weekly newsletter by clicking below and joining us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.